Well, hello, and welcome to part 2 of our 4-part series we call Year-End Tax Planning Ideas for 2020. And we're getting started right now. I'm John Williams, the owner and advisor at Ironwood Wealth Management. In part 1 of this series, I discussed several potential year-end tax planning ideas, and today I'd like to discuss a few more. Something that the new CARES Act offered is a new charitable deduction that's available to taxpayers who don't itemize their deductions in 2020. This new benefit, known as a universal deduction, allows for an above-the-line or before you calculate your taxable income charitable deduction of up to $300 per individual or $600 for a married couple filing jointly. To qualify, the charitable gift must be in cash or a cash equivalent and made to a qualified charity, and you have to do it on or before December 31st of 2020. As this draft 1040 from the IRS website shows, this deduction can be taken before you calculate your adjusted gross income. So if you're itemizing, or you did last year, and you like to give to charity, please consider using this deduction and also remind your tax preparer that you did. Moving on, qualified charitable distributions are a strategy for retirement savers. As part of the SECURE Act, did you know that required minimum distributions, or RMDs, have been changed to start at age 72, and it's no longer age 70 and a half. Also, this new CARES Act allows for folks to skip or not take your RMD this year in 2020. Qualified charitable distributions are a tax law provision which allows retirement savers who are over age 70 and a half to directly distribute up to $100,000 to an eligible charity directly from their retirement account and not pay taxes on the distribution. One idea that experts suggest is if you are charitably inclined, consider using part or all of your required minimum distribution for one of these qualified charitable distributions. Like many of the other strategies that we are discussing, this is one you should see us about if you're interested in it and having your situation evaluated. Moving along, in 2020, long-term capital gains still receive a tax break. And here are the 3 tax rates, which are 0, 15, and 20% for long-term capital gains. One item that many taxpayers should think about is tax gain and loss harvesting. Harvesting capital losses is a strategy where a taxpayer sells assets that are currently at a loss to offset capital gains. That can reduce or eliminate the tax on current capital gains. On the surface, loss harvesting produces an economic benefit that is equal to the tax amount that is saved. However, sometimes it could only produce a timing benefit. This is a tax deferral strategy that can be very valuable for some folks. Capital losses are a highly effective tax method if they can be used to offset income, which is taxed at higher rates. A key fact to remember: you can use up to $3,000 each year in a capital loss above your capital gains to offset ordinary income. Also, as a warning, watch out for what is called the wash sale rule. This rule prevents taxpayers from repurchasing a substantially similar security that you had sold for the tax loss within 30 days of selling that at a loss. If you have any questions on loss or gain harvesting, just give us a call or call your tax professional. Now, capital gain harvesting means taking capital gains in the current year. On the surface, it might appear that taxpayers should always harvest gains if they think their rate will be higher down the road. However, harvesting gains introduces a trade-off between lower tax rates versus the loss of tax deferral. Remember, when taking a gain for tax purposes, although the tax may be paid at a lower rate, it is also going to be paid sooner. In part 4 of this series, we are going to talk about some tax policy proposals, but this is timely. So let's take a look at one of former Vice President Joe Biden's tax proposals that is about capital gain rates. The proposal is to eliminate the preferential rate for long-term capital gains and qualified dividends on income over $1 million. Now, this is fairly significant because it's a fundamental shift since capital gain rates have never been eliminated for any taxpayers. For those affected, it would basically double the rate by going from 20% to 39.6%. If it looks like it could be enacted, then some people may sell assets at today's lower rates. So to wrap up this segment, I want to quickly review how today's long-term capital gains and qualified dividends are more favorable now than they have been in the past. As you can see, more taxpayers currently enjoy a 15% capital gain and qualified dividend rate than in the past. But if there is a change in the White House, certain proposals could raise the rates for taxpayers on the higher end. Be sure to tune in to the rest of our 4-part year-end tax planning series for more important information. And please remember, your health and well-being is a high priority, and we appreciate the trust and confidence that you've placed in us. We'll see you in part 3.